Hey, so in this video we're going to talk about the 15-minute bar and why it's so important and helpful whether you're putting on a new trade or managing an existing trade. So my name's Trader Tim. I'm from EminiMind.com is where you can find more about me. We've got lots of good activity going on here in the ES, and I wanted to run through my trades as well from this week. So let's dive right in. If we start on the weekly chart, we can see that on the gap up on Tuesday, we came very close to our full 50% retracement short. And if I go to a daily chart, we can see it a little bit better. And then we'll drill down to the smaller time frames and go over some trades. So that was the gap up on the morning, Tuesday morning. Now, yesterday we had the Fed meeting announcement, and today's Thursday. We had the gap down and the sell-off. And so, a couple things to note. One, we've got the fib retracement short above us that could, it was acting as resistance and didn't even make it there. But when we have a gap up like that, and let's say you were short, and or you had some type of overnight position, a swing trade position on, and the market gaps, and you're short and the market gaps up at the open. What I like to do is come to the first 15-minute bar, and instead of just getting out of the trade right at the open, hey, the market gapped against me, I just got to flatten the trade right at the open. What is more effective is to put your stop above that first 15-minute candle. And just, if you're trading a stock, just do, 10 cents or whatever above the first 15-minute candle. And if you got a futures contract, even just one tick above the candle's high is good enough. And that way, if we get a sell-off off the open, like we did on Tuesday, like happens a lot when we have a gap up in that situation, you can stay in the trade and you don't have to exit for a loss or for less profit. And look where we are in 3 short days. We're already back down here below lows. So that's the first tip with the 15-minute candle. We'll talk about the breakout here in a second. The other opportunity to make quite a bit of money early in the day, especially with the trading futures. Before we go to that intraday chart, I wanted to highlight the swing low back here. That is really been my line in the sand on these little pullbacks we've had along the way. Today we're just at the point where we're breaking that swing low, and the market's not closed yet. Got about 2 hours left, but that if we close below this swing low, that's going to be a pretty big deal. So this downtrend line here is the longer term trend line. We talked a little bit about this in the Tuesday live session this week, how we had these pokes above, a poke above, and then most recently we've spent a little bit more time above this downtrend line. So we're really at an inflection point. Yes, we could pull back to the 50% long, and then that maybe catapults us up above this downtrend line, but if we start to roll over, and especially if we break 37.45 on the ES, we're likely to come back down here to lows, and then even more so down below that area. If we look at the target for that 50%, it's 41.55. That's all the way down here in the 32.50 area for the ES. So we're at an important point in the direction of the market, and going into next year, 2023, maybe the second week in January, I would guess that we would start seeing a trend develop. So it might be slow the last week of the year and the first week of 2023, but as traders come back and start ramping things up, watch for a move that can kind of shape our trend for the spring. We've also had an increase in volatility without, we were moving up. The market was actually moving up here for a couple of days on this upswing here, but volatility actually went up too, this whole move here. And so now we're kind of at this point where we're rising yet again back up into the kind of mid 20s. So great place to be day trading, but just I always like to keep my eye on that. Today, the first 15-minute bar proved to be another great 15-minute opening range breakout. So today we gap down, and then just using the first 15-minute candle as the bracket putting a buy stop 1 tick above highs, a sell stop 1 tick below lows. Whichever way the candle breaks, that's the trade direction that I go with. And then the other end ends up being a stop. When the candle is larger than 20 points, like it was this morning, I'll just use the midpoint of the candle. So the candle itself was 22, just over 22 points. So using 11.5 points or 11 points as the stop, just to keep the risk down, is what I've been doing lately. And then just using a 20-point target. That thing broke, and within 15 minutes we hit that 20 points. So had a winner today with the opening range breakout. We had another one on Tuesday. Yesterday I didn't trade because it was the Fed meeting announcement. But anytime we have a gap like this and we don't fill the gap in the first 15 minutes, I'm taking that 15-minute opening range breakout, and that's really been a nice moneymaker for the last couple of years, and especially the second half of this year, even the first half of this year, but more so the second half because volatility's been higher and we're getting these 20-point moves really, really quick. I want to touch on a trade I did not take for reasons being that we talked about this in the Tuesday session. And if you go to a 1-minute chart and you find instances where we have a low nicey tick that corresponds with a hammer on the 1-minute chart, or a high nicey tick that corresponds with an inverted hammer, those can be good opportunities for taking a almost a bracket trade in itself, where you're doing a buy stop 1 tick above highs of that candle. If I go to the corresponding 512 tick area, that was right here. And so, but the reason that I didn't take this particular trade is because we were closing in on the top of the hour, and we did have some news announcements coming out right at the top of the hour. And I don't like to put on a trade when we have a news announcement coming out. So usually like 3 minutes before the top of the hour, if we've got news, I just won't put on a trade. If I'm in a trade, I just keep it on. Hopefully I've already got a first target hit. But for that reason, it was a nice looking hammer. We did have a low ticket lows at that 759 mark, but we're coming right into news. So that's why I didn't go long there. Got a little bit of a break, and then you can see it rolled over. On the 512 tick chart itself, we could draw a retracement like this and see that it stopped right at the short. So kind of two reasons, I guess, to not take that trade. But another thing I wanted to touch on here is so if you're coming into the day and you're drawing up retracements, kind of switching gears from the 15-minute to the retracements, I always start just at the trading hours only. So I'll look at the overnight data just to get a sense of what was going on. Were we trading above or below the close of the prior day? Where did we spend most of the overnight? But then I turn that off. And if you're going to start trading from the open, it's just an easy way to start with your drawings. And so in this way, you can just start from the first bar, and then in this case we move down. So then just drawing to the most recent swing low, and this one really did not get anywhere near the 50% retracement short. We were pretty bearish. The breadth of anticline line have been strongly bearish all day long, so no surprise that we didn't get that kind of a bounce. But see how we came and touched the negative 23? At that point, it's okay to draw up the next retracement from the swing high down to the swing low. So even though we didn't make it to this 50% retracement short, when we're extra bearish on a day like today, just go ahead and draw up the next retracement from that swing high that didn't quite make it, to the 50%. And so when we, let's see, go forward here. Actually, I gotta go backwards a little bit. So if you're zooming in, this was later in the morning here, 10:30. It's at that point when you identify the resistance on the 5-minute chart that you can turn to the 512 tick chart to look for your entry. But I actually wanted to back up and talk about a trade from a little bit earlier in the morning, and it was actually at that 15-minute mark. I'm going to go to a 1-minute chart just to zoom in a little bit. And 15. No, let me put this back on there. Do, do, do. So, um, I believe it was this one here. So, drawing up a retracement like this, and when so the 15 minute was right about there, give or take. 15-minute low. I'll flip it. I'll put it back on. So if you didn't get in on the 15-minute break down, if you will. So there's the 15-minute low. So if you didn't get short below that 15-minute low, then what you can do is come in here and the 750 mark. It was a low tick. It was not a low tick of the day. So looking at a place to get short, if you draw up the retracement on the left chart first, the 5-minute chart, then you can come in, or even if you draw a larger retracement like this, let's say you weren't even looking at the 5-minute chart, but you have a larger retracement on the 512 tick chart, if the distance between the 50 here and the 61.8 is less than 2 ticks by the time so 64.75, I would want to round down for my entry, so 64.50. And then if we go up by two points, that's 66.50. So it's just barely outside of the 61.8. I like it when the stop is, 2 ticks outside the 61.8. So if you don't want to go short right there, what you can do is first you want to just draw up the opposing trade, like the opposite directional trade. So here is a short. I want to draw up the long and make sure we break that 61.8 before coming in and drawing up the next little, what I would call a micro short, and then use that as the entry. So 39.61.63, round down 61.50, subtract your tick for your entry price, 39.61 1/4, and then that's what gets you in the trade, and then you can just start, trailing the next 61.8, whoops, like that. And then, as soon as we start dive bombing here, just go ahead and trail each swing high on the way down. You could even come in here and just start trailing each candle on the way down. You can catch a pretty big chunk of the move, even if you just trail 2 ticks, 1 or 2 ticks above each candle, and right from there, the 61 1/4, down to the 39.40s. I mean, it doesn't look like a huge move, but this is 20 points right here. So lots of opportunities to get short, even if you didn't take the 15-minute breakout. But the key is you want to make sure you get that opposing break. Otherwise, like we pointed out over here, if I wanted to go long, get rid of this, the opposing 61.8 did not break. And so taking a long here, not a good idea because we didn't break the 61.8, let alone break the swing high. So those two checks really help me stay out of trades that end up just rolling over and would have stopped me out. And if you can eliminate a handful of extra losses, then it magnifies those winners, and then you can really go from if you're just a break-even trader or just kind of treading water, that can really put you over the edge, get a couple of runners, and all of a sudden you start having positive weeks, positive months, and then your consistency really starts to come around. So this will probably be the last video for the year. We'll see. I guess next week we technically. Pretty much a full week of trading, but we are going into the Christmas holiday, so by the end of next week, things should start to slow down quite noticeably. But if you have questions, you can head over to the Discord, search for EminiMind. We've got a good chat going on there, and you can drop questions in the comments below. And I hope everyone has a great holiday season, and we'll talk to you all soon.